Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com. Today is Friday. It's the 17th of June, 2022. Just going to bring up our high-risk investment warning. Keep this on screen for a few moments. Good morning, Zinette. Hey, Raj, Howard. It's a pleasure to have you on the webinar. It's a pleasure to have all of you on the webinar. Thank you very much for joining this morning. Hey, Anna, good morning to you. Nice to have you guys on the webinar. Here's our market commentaries disclaimer. And let's just go through our references. So we will certainly refer to Market Scope 2.0. CNBC.com and perhaps TradingView.com. I think maybe we will look at TradingView as well. In fact, I'll just put up the 10-year just on screen whilst I go through the CNBC morning article, which has the headline: European markets head for cautiously higher open to end a tumultuous week. European markets are heading for a modestly higher open on Friday, but are on course for a bruising week as global stocks reacted to policy tightening from major central banks. The US Federal Reserve on Wednesday raised its benchmark funds rate by 75 basis points, its largest hike since 1994, before the Swiss National Bank surprised markets with its first hike since 2007. And the Bank of England implemented its fifth rate rise in a row. The European Central Bank announced following an emergency meeting on Wednesday that it plans to create a new tool to tackle the risk of Eurozone fragmentation, a move aimed at reducing fears of a fresh debt crisis for the common currency bloc. Stateside, the S&P 500 is poised for its worst week since March 2020 after several key pieces of economic data fell short of forecasts this week, ranging from May retail sales to housing starts, compounding the Fed-induced recession fears. Stock futures rose in early pre-market trade on Friday as Wall Street looks to arrest the slide. Shares in Asia Pacific were mixed overnight, with Japan leading losses among the region's major markets. The Bank of Japan on Friday decided to maintain its ultra-loose monetary policy stance, diverging substantially from its global peers. On the data front in Europe, final Eurozone inflation readings for May are due on Friday morning. Okay. This market is challenging. Let's just put that, let's say that up front, get it out the way. Gee, it's a challenging market. There are so many moving parts here. It's actually difficult to know where to start. Well, we're going to start the analysis with the DAX. But before we get there, just as an aside, and I've got to give this some thought. So I was looking at the Japanese 10 years yesterday, and unless there was some sort of data glitch, which I'm about to see now. Let's use this one. Yeah, unless there's some sort of data glitch. I couldn't find any news on this. There's this huge spike up here. This, to me, seems incorrect, but I just wanted to show you what, it was a public holiday yesterday, and I just decided, well, I'm going to just throw up the JGBs. And we all know that the Japanese central bank's defending this 25 basis points area, and I was thinking, what on earth is going on here? And of course, it looks like some sort of data. It looks like a mistake, to be quite honest, because we're back at 25. But this would be a huge news item. I couldn't see anything. When I did I didn't look particularly hard, but I did a sort of a cursory sort of search and couldn't find anything. And I guess the takeaway here. So in the note, it was saying that the Bank of Japan still wants to maintain a dovish stance, while every other central bank in an industrial country is tightening. What gives? Well, I think that's a valid question. What in fact does give? And it looked as if the JGBs were about to give, but we're back there. So I guess we just got to watch this. So I wanted to point this out. I wasn't sure what was going on here. Just taking a look at where the price is, or the yield is this morning, I would suggest yesterday's movement's probably a mistake, but just wanted to show you guys that. All right, let's go ahead and bring up the DAX. Howard's saying he's reading an article on TradingView which says the Fed may raise rates by the same amount next month. I think that's a decent assumption, Howard. I think that's a decent assumption. I think we will get 75 next month, but we'll have to see, of course, how the news comes in. But I think that's something that's probably certainly. I think the probabilities are strong. All right, let's take a look at DAX. Just taking a look at this on a technical basis. All right. So these peaks and troughs is something we put in earlier in the week. And when you've got a lower peak and a higher trough, well, that's a triangle. Okay, so everything in technical analysis is actually peaks and troughs. It's just a matter of the pattern of those peaks and troughs. And once we get those, the pattern, well, that's what a technical pattern is: head and shoulders, a pennant, wedge. It's all peaks and troughs. Okay, so we can see here that we have a breakdown out of this consolidation pattern. So this is sort of the new reality, the new paradigm. It's different to where we were at the start of the week, or let's just say it's different from where we were last week, Thursday. Because Thursday we had the ECB come in, say they're going to raise rates. That hurt the DAX. Then we had the miss in the US CPI. That hurt markets generally. And what we were talking about was the 15,000 level as being a significant level. And we wanted to see how the market reacted there. Well, the market's reacted by setting down the DAX, and now we've broken out of this consolidation. And we don't actually have a triangle anymore. We don't actually have that. We've got something far more sinister. And so let's go and put those in. Okay, remember we're on a weekly chart here. All right, let's start the labeling from the beginning. So we've got a peak. Okay, we've got a trough. All right, once we've got the first peak and trough in, then it becomes just how dangerous the market is looking. We certainly are on a knife edge, a precipice. You can see that we have a lower peak here. Okay, well, that's noteworthy, but what's more noteworthy is that once you have a lower peak followed by a lower trough, that's a downtrend. So DAX has now moved into downtrend. Okay, of that there's no really getting around that. It meets the definition of a downtrend exactly. A lower peak followed by a lower trough. That's what we have here. Okay, so the triangle, that's gone. Okay, that's no longer relevant. Now what we have to do is measure the progress of the trend, because we've got a downtrend. So there's a few ways, a few things to consider here. The first thing to consider, of course, is underlying support, which looks pretty strong to me. Okay, this level here, we were looking at 15,000. Now we're kind of looking at 12,500 as the next key level. Does that arrest the price decline? If it does, okay, does that bring in the next lower peak? And if it does that bring in the next lower trough? So that would be a very severe scenario playing out. That's the bear market unfolding. The best way forward for the DAX would be a higher trough followed by a higher peak. Okay, that's the best way forward. That would put it back into uptrend. There would be a lot of sort of price action here, so we'd have a lot of support resistance to try and deal with. But as it stands right now, this is looking very very dangerous. All right, let's just see here. Raj is saying he is experiencing sound issues. Can I just confirm? Is anybody okay? He says it's okay now. I'm just seeing there's a couple of good comments here. Okay. All right, just something from Anna. So it's I'll just read this. It's a paragraph. Just give me a moment. Japan, in contrast, does have an independent central bank and has relatively low inflation of just 2.5%. Consequently, its monetary policy is at odds with most of the rest of the developed world, as it is keeping interest rates close to zero. This is why the Japanese yen is hovering close to a 20-year low versus the dollar. The Japanese Ministry of Finance and the central bank issued a very rare joint statement, said that they are monitoring the situation and that rapid fluctuations are not desirable. In truth, though, there isn't a lot that the Japanese central bank can do about yen weakness except for raising interest rates. Exactly. The worry is that China may see this devaluation as giving an unfair advantage to Japanese exports over those of China. That's interesting. And economist Jim O'Neill, who was a currency strategist at Goldman Sachs at the time of the Asian financial crisis, put it as follows: if the yen keeps weakening, China will see this as unfair competitive advantage. So the parallels to the Asian financial crisis are perfectly obvious. China would not want this devaluing of currencies to threaten their economy. Okay, and that's interesting, Anna. I think this is a story that we've got to monitor. When I say the story, I'm actually talking more about the Japanese monetary policy, even more so than sort of a currency war here, because it's incorrect monetary policy in sort of the expanding environment. But we'll have to see. Their inflation probably a little bit more contained than the rest of the globe, so they're getting away with it at the moment. All right. Okay. The next part of this analysis. Okay, the next part of this analysis is just the momentum. Okay, so we've got the lower peak and we've got the lower trough. And we're saying this is looking quite dangerous. How do we monitor the danger going forward? I think the way to monitor it is with stochastic, because that is momentum. And at the moment, it's in no man's land. So I mean, if it stays in no man's land, then perhaps the support level holds. But if we move towards this lower quintile, which is under 20, and hold there, then it gets compounded. What gets compounded? The bear trend gets compounded, because it means that there is strong momentum to the downside. That is dangerous. Momentum is either, you can either treat momentum as a friend or an enemy. It's best to treat it as a friend, okay? Because if you treat it as an enemy, you're going to lose. What am I saying? What does that mean? I'm saying that going short when momentum is behind you is probably, apt. Going long when momentum is against you, it's probably incorrect. going long when there is momentum that is supporting higher prices. That's probably at, etc. Doesn't mean that your trades are going to be necessarily winners. That's why you use risk management and stop losses. But if you are shorting into strong momentum, you're gonna get pulverized. And if you come out unscathed the first time, you're going to get pulverized the second time. At some stage, you're going to get pulverized. Okay? So it's best to just keep an eye on the momentum. Over here, it's in no man's land. It's rolling over. We wanted to see if it heads towards that 20 level. Okay, if it doesn't head towards the 20 level, then I would suggest we may have a bottom here. We may have. Okay, so it's very much kind of depending on the momentum. All right, so let's go down to the daily here. See what's happening. Give me a moment. The cash open. The market's just opened. The cash opens just gone live. So my system's hanging. Just give it a few moments. All right. There we go. Yeah, here's this momentum. Okay, so on the weekly, it's just turned down. On the daily, it's down. Okay, we're in the lower quintile. Now, there's no such thing as oversold or overbought on the stochastic. The mathematics doesn't make any provision for that. Okay, so but we can put in an RSI to see what's happening. So let's put that in. All right, so we getting to a point where it's near oversold. There's still some, we'll call this tending towards oversold. So there's still, there is still potential for movement before we kind of get a floor locked in. But we are getting, I would suggest, towards the nadir of this swing, but probably getting pretty close to sort of the bottom of the swing. But again, the momentum is really, I think, the story here. As long as it stays in that lower quintile, then the market is going to feel it. So let's just put everything together before we go down to the hourly. We do have a downtrend. Of that, there is no there's no point in doubting it. The definition has been met. We're in downtrend. Okay. So now we're in downtrend. We wanted to see if the daily chart cooperates with the weekly chart. At the moment, it is. Okay, we've got very obvious downwards momentum. We've got very obvious zone 3 position. Let's go to the hourly chart, and this is where it gets super interesting for us as traders, because this is where we can try and take advantage of the higher time frames. Is there any guarantee here? No. That's what we must understand. There's no guarantee in trading. That's why we always use stop losses, and we always use risk management, so that if we are wrong, then it's negligible. Okay. And what we can see here, we're zooming in, is that there's potentially a bearish cross, signal 1. Potentially a signal 2. If we get signal 1, signal 2 pulling, okay, there's the bearish triggers. That lines up with the downtrend. That lines up with the daily momentum. And now, will that trade pay off? I don't know. But if it gets down to the lower 20, the lower quintile, it's probably moving in your direction, barring any unforeseen news that disrupts the sentiment. Then it's worth having, well, it's not worth, you must have the stop loss in, just for unforeseen variations. Okay, but the two triggers in of themselves won't make the successful trade. It's the momentum that's going to make the successful trade. So there's still a bit of work to do here, but it looks as if it's lining up quite nicely, right? Looks as if it's lining up quite nicely. So if it's lining up quite nicely, let's just understand what's happening on the yield side of things. So we're just going to we'll bring up the Bund just to bring in some fundamentals here. Okay, so let's just go to the weekly. So this is, I think this is a tricky chart because I think there is some perhaps some need for moderation here, which is again one of the reasons why the market is so hard to read. But let's just throw in the RSI here. Okay, so the Bund to me just seems really overheated at the moment. I think that there is certainly scope for a higher German Bund, but it would be interesting if it doesn't normalize. If it doesn't normalize here, we must ask what could possibly be the reason that it doesn't normalize. Now, first of all, I would expect it to normalize because that's generally how price action behaves, but not always. We know, you know, Bitcoin, when that left shoulder was formed, there was a lot of excess in the market, a lot of exuberance in the market. That could be with the German Bund as well. Because think about it, we've come from negative. We've come from negative. That's disrupted. That negative interest rate has disrupted behavior. Okay, because negative rates are odd, to say the least. So it's very you know, confusing. But I would expect this. I would expect some sort of normalization, and perhaps if there's some sort of normalization, perhaps then we do get the sort of that 12,500 level acting as support. But then I think the next danger is the next lower peak in the DAX. So it's really confusing in what's going to happen with the Bund. But you take the Bund out, the technical picture is very clear. We're in downtrend. Now, if we're in downtrend, any rallies are potentially exploitable. But this is a rally here. The rally here. So it's potentially exploitable. Okay. So that's something to keep an eye on for today. I think that, and it's not just that, we can also add in that the central pivot is a resistance area, and it's got an overlap with the support. This is the polarity principle, right? Support turning into resistance. So this central pivot here, very, very interesting for me. I am looking at this very, very carefully. All right, let's just take a look at US dollar as well, because there has been that 75 basis point movement. And let's take a look and see what's happening here. Okay, so I think we're going to have to put an RSI here in as well. We're looking at the weekly. I think before we bring in the RSI, we've got a let's just change this. We've got this as a, we'll use this as the base. Okay, so we've got a trough peak. Once we've got that in, you can see the uptrend continues, higher trough, higher peak, right? Look where the momentum is. The momentum's in that upper quintile. That's strong momentum. Got to just watch that 80 level. Is it falling out? And if it does fall out, you know, does it fall all the way down or just sort of take a bit of a break and move back into 80. My suspicion is this area is pretty well supported. But let's just take a look at the RSI. All right, so we're kind of tending towards that overbought. Right. Probably a little bit of movement before we get there, but we're tending. So I think over the next sort of the next few candles, we do get a ceiling locked in. But again, that's probably temporary. In my opinion, it's probably temporary until monetary policy moderates in the States, which I don't see happening in the near term. Let's just take a look at this on the daily. So on the daily, we are in zone 1. Just keep an eye on the stochastic. It's slipping from this 80, but again, I'm not certain if this is not a dip in the uptrend for us to keep an eye on. And you can see that the stochastic is moving into the upper quintile. We've got the crossover here. As long as it maintains in this upper quintile, there's probably going to be strong dollar. Okay, so the dollar moving into tending towards overbought, DAX tending towards oversold, not quite there yet, but we're kind of moving into those areas. I think we have to keep an eye on those. There was the one last chart I wanted to show you guys, and then if there's any questions, please go ahead, type those in. The last chart will be here, and it's initial jobless claims. Initial. All right, we can get rid of the RSI here, and we can put in a, so this is a weekly, okay, so this is a weekly series. We get jobless claims out every week, so we're just throwing the 52-week here. Just going to make it a simple moving average. Yeah. Let's just take a look. So there's two ways to look at this. The first is on the 52-week basis. So let's just see where we are with the 52-week. All right, so we're approaching the 52-week, so we just want to keep an eye on that. This one over here, what we can do is just change it to 12. And let's just change the colors that are similar here. Let's make this red. All right, so we're above the 3-month average in terms of initial jobless claims, and we're approaching the 52-week. So we just want to keep an eye on that. We want to throw in one more indicator here, and then we're going to make a sort of then we'll do the analysis. Let's just throw in the stochastic. So stochastic is momentum. Okay, what's happening with the momentum of the stochastic? It's not looking good. We've hit the upper quintile here. Okay, the longer we stay in this upper quintile, the worse the initial claims is going to get. The worse the initial claims get, well, we'll be over this 52-week then pretty soon. We're already over the 3-week average. What am I saying here? saying that the unemployment rate is a lagging indicator. Jobless claims is a coincident indicator. We've been talking about how important the unemployment numbers are in terms of seeing the soft/hard landing. Well, we are starting to move into what suggests to me the beginning of this hard landing. So we want to just keep an eye on that 52-week, and we want to keep an eye on this. We're already above the 3-week average. Sorry, the 3-month average. I beg your pardon. 12 weeks, 3 months. Okay. Okay, cool. Chris just saying that the volumes are also quite noteworthy in terms of the indices, suggesting a real crash. All right, so what we can do is let's just bring up SPY. Bring up SPY, which is an ETF of the SPX 500. So let's just take a look at the volume on the ETF here, Chris. Let's see what it's showing us. So while we're looking at the SPY, because that's a traded instrument, so we can get an actual pretty good reflection of the volume, what's happening on the volume. Volume, we always want to look at volume on a daily, okay? And then my preferred indicator here is unbalanced volume. So I haven't looked at this before. Let's just see what unbalanced volume is showing us. I mean, I have looked at it, but not recently. Let's just see. OBV. Okay. So, you know, what Chris is saying, he's saying the volume here is just showing a real collapse. And unbalanced volume so is supportive of that. Chris, so what the OBV is, it's just basically, you start off the indicator, you just you select any start. You can start with 0, you can start with 1, you can start with 2, you can start with 100. But then what you'll do is, on every up day, you'll add the volume, and on every down day, you'll subtract the volume, and then you'll just get a series, and then you can start looking for divergences for when when it looks like there is some sort of accumulation or distribution. So where would the distribution be here? So the distribution here, again, in hindsight, you can see it. Okay, here is price moving up. So we're going back sort of to January, but the market, whoever's, whoever the pros are, they're selling out. So there's your distribution. And then, of course, you can see that it sells down quite strongly thereafter. So that's the S&P. I'm just thinking, you've also got something called the. So this is the spider. The Dows would be the diamond. Let me see. I can't. Diamond. Yeah, the DRA. This is what we're looking for, yeah? Okay, here's the DRA. Let's bring this up. This is interesting on the Dow. It's not quite as severe. It's not quite as severe. Okay, you actually got a slight divergence here, which is interesting. But it's looking like it's about to break through it. Okay, that's interesting. So that's very interesting. And I think for NASDAQ, I think we use QQQs, but I'm subject to correction here. Let's just see our QQQs. Yeah, Invesco. Well, let's use this one. Invesco NASDAQ 100 ETF. Let's see this one. This has just got volume just rushing out of this. Let's see if we can see the divergence. This happens concurrently. Okay. Happens concurrently. Okay. Must be on the daily. Must be on the daily. I'll explain that quickly. Why it must be on the daily. Let's just say you have 4 days of down volume. Let's say you have 4 days of down volume. Sorry, let's say you have 4 days of 4 down days. Let's say you have 4 down days, but the market, the price movement is negligible. But let's say the volume is heavy. In other words, whoever's exiting is managing to exit pretty close to market price. They're not really moving it, but there's no doubt that there's distribution taking place. But price hasn't quite reacted too strongly yet. Let's say on Friday, the market actually ends up for the week on light volume. If you look at that on a weekly chart, it's going to show you a whole lot of positive volume for the week, but that's not showing you the reality. The reality is that there's distribution 4 out of the 5 days. So you must look at it on a daily chart. Okay. What does the fear and greed index show? There's no other webinars today. I'm not sure. So the fear and greed index is not something I look at all that often. I think I've looked at it once. It's a as far as I understand, it's a crypto derived index, fear and greed index. So yeah, I'm gonna have to get back to you on that one. Fear and greed, but I think that the idea here is. Let me give this some thought. We can take a look at the VIX in the meantime. Oh yeah, the NSA and VIX, yeah. Okay, so so this is the VIX. So what's the VIX? The VIX is it measures options. But you must understand on what options we're looking at. We're looking specifically at options on the S&P 500. So it's representing fear on the S&P 500. And what we can do is we can put an S&P 500 chart underneath. So let's just do that. And let's just add in a logarithmic scale here. And basically, my reading is, the 40 level is kind of the line in the sand here for our panic selling. Again, it's not a hard and fast rule, but I have read some guys look at 30. I think 30 is too low. I think 40 is kind of your line in the sand. So when we had that big sell-off in the end of 2018, we hit about 40. When we hit the lockdown period, we went well over 40. We haven't quite got that. We haven't quite got that here. Going back to, this seems to be, let's go back to the global financial crisis. Yeah, over. So for me, 40 is kind of the area of interest. So what is that 40? That 40 is kind of the panic selling, that capitulation that we want to see effectively to move into that renewed confidence stage. So let's just see if that happens. I don't think we've hit that panic selling yet. Again, I want to sort of tag the phrase subject to correction because I don't know, but I think that there is quite likely that there's another leg down, the real kind of capitulation where there's just an absolute last gasp, and that's probably what we'll see here. How I think that's what you So with the blue, so what you basically want to understand, so what you want to use the VIX for, you want to use the VIX as a contrarian indicator. So when things, so blue over here, if it goes over 40, it means that there's a huge amount of put options that have been taken out because people are getting nervous. Put options is what you'll use to take advantage of a weak market. So what you would do, you'd actually say, well, no, that's the crowd. I want to be away from the crowd. So you'd use it as a contrarian type of indicator. Whereas when we're at the bottom here, kind of near sort of 12 to 15, I would suggest, that means sort of there's a whole lot of positivity in the market. You probably want to try and, you know, the crowd is always right except at turning points. So that's effectively how this indicator would work. Does that answer your question, Howard? It's not really a matter of blue red. It's a matter of where we are on a level basis. And then of course, and it says let's just take a look at the S&P using the COPOC, and I think that is a terrific idea. So let's just bring that in. Now, just remember here, Anna, that we're looking at this on a monthly. Okay, so we're looking at this on a monthly. So that's noteworthy because it's only the 17th of the month. Okay, so we don't really have a complete picture here. This only effectively closes. This candle only effectively closes at the end of the month. So just be aware that although there's a lot of red here, suppose that there is now a lot of buying that comes in over the next 2 weeks, right? That would change the candle considerably. So bear in mind, when we look at the COPOC here, we're looking at it on an incomplete candle. I'm not sure it's going to make all that much of a difference. We'll only know that at the end of the month. Okay, so let's just bring that in. So you can see we're not quite there yet. Whereas, say, let's just take a look at Nasdaq. Nasdaq's much closer. Again, the idea is where are we at the end of the month? But an index, say we look at the China 50, right? So we look at the Shanghai Composite, so the 50 companies there, and we take a look at that. Then we don't really have to wait until the end of the month because it's in negative territory. We know it's in negative territory. It's been in negative territory for more than a month, right? So that's the difference there. Okay. Yeah, no worries, Aneta. No worries. Rob, right. I don't have the link, Rob. If you have it, then you share it. I'll send it through to everyone. But Rob's just saying there is an article on Coinbase explaining the Fear and Greed Index. It combines all sorts of info such as momentum, volatility, social media, etc. Here it is. Sorry, not Coinbase, CoinDesk. Sorry, let me just get this. Thank you, Rob. I'll just share this with everyone. Hang on a second. I haven't done a very good job there. Give me a moment. So I'm resending that because I only got half the URL. Yeah, there we go. That's better. All right. Okay, Raj, have a good weekend. Nice to have you on the webinar as always. Anna's saying Benjamin Cowan does a good job. There's a good video on it as well. Chris just suggesting we take a look at the DAX and the COPOC, which I think is a good idea as well. Let's bring that up. Okay, cool. So this is interesting because we're pretty close, aren't we? We're pretty close. So you can see how close the DAX is now. once we get, so this is very, I think this is a good place for us to sort of explain a little bit more about the COPARC. And so it's effectively, it's like sort of cocking the gun, right? What I mean by that? So it has to drop below 0. So that's kind of the sort of putting the hammer back, or whatever you call it, right? And then it needs to turn up, and that's the kind of like putting the trigger. So there's two things we need to watch for here. So yes, this is very close. This is very close. So we need to see it drop below, and then we need to see it turn up from below. And I think then, Chris, that would be a very, very interesting development, okay? Because I think that would be a suggestion that perhaps we're moving from that panic selling stage into that renewed confidence stage. And the next thing to watch for there, by the way, would be, is there bad news coming out in the press? And is the market ignoring that? Well, then we've got a very good chance that we're at the beginning of a bull market. So this makes the analysis really, really interesting, taking a look with the DAX. So thanks very much for that, Chris. That's a really good looking chart there. All right. Are there any other questions? Have I missed anything? Have I missed anything? I hope not. I think I've got everything. I think what we can do is conclude at this point. And then if anybody needs to contact me, you have my email address. And then have a good weekend, and we will start it all again on Monday morning. Thanks very much, guys, and chat to you soon.